And welcome to another episode of the Multifamily Naked Truth. I have special guest today, Thomas Poboyevsky. I'm sorry, I probably got that totally wrong.
It's all good. I've lived with it since I was a kid, so it's part of it being so unique.
Thank you very much for being a part of the show. I've been really trying to reach out to people in Ontario, because especially the areas that you're servicing, Toronto, Brantford, there's a whole bunch of them, in your bio there, in a very heavily populated area of Ontario. So we obviously have a lot of people, and we obviously have a lot of renters. So hence, there's probably quite a bit of multifamily activity in the area.
Oh, absolutely. Yeah. I mean, there's definitely a shortage of inventory out there. Rental demand is extremely high right now, and we're just seeing that rents are certainly increasing. The demand is there, and there's a shortage, like I said, of inventory, which has been the trend for quite some time, and I don't see that changing anytime soon.
Now, I want to just go back to what we just talked about before I hit the record. We're kind of talking about the spread between cap rates and, yield, right? And we haven't really seen the cap rates come down yet, right? Go up, right? Considering the rates have continued to climb. And as we see this morning, there's still a 0.75 jump. Is that pretty much consistent with Ontario? Because that's pretty much what I'm seeing in the West so far as well.
Well, to give you some context, Corey,
Yeah.
the markets that I mainly handle, so you've got kind of anywhere within an hour of the GTA,
Okay.
and anything that I've kind of looked at in general, kind of those bigger markets. So you got your Kitchener, your Hamiltons, Barrie, and so forth. Yeah, the cap rates surprisingly haven't changed. They have remained fairly low, yet the cost of borrowing has gone up considerably. So when it comes to the financing, especially when you're limited in terms of DCR calculations, it really, really makes it difficult to get a high loan to value, especially on, like, for example, conventional financing. So a lot of investors, quite honestly, they are buying with the hope of doing turnover strategy and then refinancing, let's say 2 to 5 years. So they may do, for example, like a bridge in the meantime, just so they can get a higher loan to value on that particular building, and then refinance it at that point in time.
Yeah, that's exactly what I'm finding as well. I mean, I had a loan opinion done on a building, for example, a few weeks ago versus the same opinion 6 months ago. And the loan has been scaled back like $400,000. Like you say, because they're still using a debt service coverage ratio of 1.3, but now you can't stretch it into any more than a 40-year amortization, right? 85% loan to value with CMHC. So the only thing that's got to give is the loan amounts. But I haven't seen that being reflected in the price. And actually, I think I've lost out on 2 or 3 deals now. It seems like, at least in Western markets, the market is stronger than ever. So I don't know if people are doing, more cash deals. Like, I've heard that I've lost out on people doing cash deals. And the second thing that you say that I just want to bring up too is a part of the strategy with with the BRRRR strategy and value add, which is often the case when you buy an older multifamily building. The rents are low. You have to take time to stabilize it. You have to factor in that bridge cost. And I did a bridge loan last year, and I'm looking at one right now. And with the rate hike today, because the bridge loans are generally variable rate, short-term mortgages, plus a bunch of fees, the costs are very high. So for that strategy, it's getting trickier as well.
I agree. I mean, it's definitely expensive. That's for sure. So you have to look at it long term. One thing I have noticed is, like, the competitive landscape has certainly at least kind of lessened, in the sense, like, there's going to be maybe one offer with conditions. I mean, before it was so crazy, you'd get into, like you said, cash deals and no conditions whatsoever. But I'm seeing that's not the case anymore. There's more conditions in place, so at least gives you the opportunity to, let's say, tie down a property for a certain amount of time frame, and being able to find a financing solution that works. But again, prices, cap rates, haven't really seen much of a change as of yet. And I think it's also just the motivation of the sellers. I mean, a lot of these sellers have hung on to these properties for quite some time at very low loan to values. Their tenants are paying the bills, and they'll just sit on it, right?
Exactly. Well, versus, they're not going to be able to go to the bank and get debt, because I can't go to the bank and get debt that they want, that they could have got a year ago. I mean, we could have got a CMHC rate last year of 1.4%. Now we're looking at, 4.5%. So, but it hasn't been, seems to have been reflected in the sales price. But that's interesting that you say that, you know, the multiple offers are going away. And I don't know if you were specifically talking about multifamily transactions or residential as a whole.
Um, Both. I mean, I'd say,
Okay.
I mean, definitely residential. I mean, you still see it on occasion. You know, obviously, if the deal is really good, you're going to see it, but it's definitely less competitive than it was in the past. So I guess, you know, the residential, I guess, you know, just strictly residential sort of properties, definitely you don't see as much competition, but on occasion you'll see it in certain pockets. But then you have like the multifamily space, and I mean, from what I've personally encountered, it's been kind of like one offer, negotiating back and forth, and conditions lasting for 6+ weeks. So
Yeah.
that's changed.
Okay, interesting. So I just want to get a little bit about your background here. I was just reading that you were an accountant not so long ago, and you've been now you know, a real estate agent specializing, you know, with investors. You know, you seem to be able to uncover these hidden gems that a lot of people can't find. You want to tell me about a little bit about your background, your career as an accountant, and what made you make the switch to real estate?
Yeah, absolutely. I mean, yeah, so I was a CPA, used to work for a big company called Deloitte Touche, downtown Toronto. And that was 12+ years ago that I worked in that field. So definitely have a numbers background. But I got started actually in just single family homes. I bought my first residential property. It was like 2009, 2010. I still have it today. It's just works out
Nice.
so well. And then it was getting into like flipping and using that as a side hustle on top of my day job. And one thing led to another, and decided to get my license and became a full-time agent. So now for the last 12 years, I mean, yes, there's a piece of my business that's related to helping investors, whether it's, you know, kind of smaller single family duplexes, those sort of properties, and you have flips, and then there's a multifamily space as well. And then there's the traditional sort of realtor that helps you move from A to B, right, which is fairly common in the GTA. That's a huge market. But at the end of the day, like, my passion really resides in helping people kind of create wealth through real estate, because I know what it did for me for the last 12 years.
Fantastic. And Ontario has been just a fantastic market to be in. You know, honestly, I wish I would have had some out there too. We've gone through some pretty tumultuous times on the prairies in the last, you know, 5, 6, 7 years, where, you know, Ontario and BC seem to just kind of go by, you know, kind of unscathed. So just switching back to multifamily for a second, I know you cover a lot of area there, a lot of like geographic area. What's what's a notable area for you know, transactions? Where are you seeing some multifamily action? Like, I imagine price per door is a lot more expensive in Toronto than it would be in London, say, for example, or Barrie or something like that.
Yeah, like a good example, like Kitchener, there was like a 16 plex there for 3.5 mil. So if you do the math, I think it was in the low twos. I mean, that was the asking price, but it went fairly quickly. So I got to figure it's got to be somewhere close to that. So like low twos, low 200s is what I'm seeing, like price per door, and there were mostly 2 bedrooms in that space. So that's like the Kitchener. Then you go to like Toronto, and of course it's going to be much more expensive. Cap rates still fairly low there, 300,000-400,000 again, depending on, you know, the building and so forth. So it's still fairly, you know, it's a pricey place for sure, right? As far as multifamily is concerned, and the demand is still there. It's still a very strong asset class.
Yeah, I mean, and low twos is comparable to, you know, what I'm seeing in British Columbia. Like, I live in Kelowna, and it's probably 300 plus a door here, and we're a city of 100,000 people. But the rents can justify those prices if you know, if the ones you're talking about, like maybe it was the Kitchener market, the 16 plex example. Now I know during the pandemic there was sort of a mass exodus out of the GTA, so rents, you know, temporarily, you know, dropped like 10% or whatever it was, as they did in Vancouver. What I'm at least hearing now is that, you know, with the increase in rates, that rental demand is starting to really soar. You know, more, you know, would-be homeowners are now renting longer, and there's starting to be a lot of upward pressure on rents. Are you finding that in your markets as well?
Oh yeah, I mean, it's crazy. I'll give you an example, Corey. Like,
Yeah.
this is not a multifamily example, but again, we have like investors in downtown Toronto with condos, and I had one, you know, this particular example, 2 beds, 2 baths, looking about 800 square feet. It was probably about, it was asking 3,000, but let's just say market was probably about 32. And we had 3,200. And we had 10 offers on that particular place over a long weekend. And the winning offer was 3,500, 12 months paid in advance. And a very, obviously a very strong candidate. But I mean, I was even blown away because like sifting through 10 applicants, and they're all strong. But this particular person just paid 12 months up front times 3,500. I mean, that's a lot of money up front. And so that's what we're seeing, right? It's just that there is a huge amount of demand, especially now with, I've always found September as well, like leading into September with students coming back to school. A lot of people change jobs during that time period. That's usually been the strongest time to kind of lease out properties. So that also, there's a seasonality in there as well.
Wow, that's crazy. I didn't realize it was that strong. So at the beginning of the conversation, we also talked about kind of the market shift and kind of investors kind of put their pencils aside. They're kind of, maybe some of them are sitting on the sidelines and just waiting for things, waiting for, better opportunities to jump in. Are you finding that with investors in general? Like, let's say it's someone who maybe does condos, duplexes, fourplexes, or multifamily, or has things slowed across the board? Or are you still seeing, I imagine there's still properties that come up for sale that are, very attractive that people are going to move on in any market.
Well, I mean, during this market shift, I at least from my perspective, the investors were the first ones to put their pens down. And however, I do think that they'll be the first ones to come back on board once they see more stabilization. I mean, they reported the numbers just in the last week, and this was the first time that we had seen kind of prices inch a little higher than the month previous. So it's not a trend yet, but we're seeing stabilization. And then going back to what you said, I mean, yes, there are investors looking to purchase, but I have found that some of them are looking to, if anything, refinance, trying to kind of build up their cash. They're playing it very cautiously at this point. I think just to kind of psychologically time a bottom, although we can never really time a bottom. But people are moving in cautiously. I mean, I'm an investor myself, so I've got like even myself like a flip on the go here. We're still looking for opportunities, and there was one even last week that I kind of second guessed myself on, like, shouldn't I? And sure enough, it's next. You always want the one that you kind of one that got away.
Yeah, no kidding. That's so interesting that you say that. So what would be your favorite asset class then? What's your favorite type of investment in the market that you're in?
I mean, depends on your strategy, right? Your goals. Like I think, at least for my case, like I have you have your short game and your long game like you do in golf. So
Yeah.
from a wealth building perspective, I mean, I've done very well even with just single family duplexes and smaller sort of properties. But at some point, you kind of want to either scale up or you just run out of credit at the end of the day. So then you got to kind of get into a new sandbox. So long-term buy and hold as multifamily or even smaller sort of properties, there's nothing wrong with that. I think it's a fantastic way to kind of build your wealth. So that's your long game, and then your short game. Personally, me, I like flips. Right now, I'm a little cautious about flips because of the way the trends are, but still, I've always liked doing them. I've been doing it for a long time, and I've do some short-term lending as well, especially in a market like this where you kind of just want to maybe park some money somewhere. I don't see anything wrong with lending it out, in the private mortgages.
Yeah, and I imagine that's getting more attractive now. I know your GICs today, they're paying more than like 0.1%. So as rates go upwards, you can actually get a little bit of yield on your savings these days.
Yeah, I mean, just like example, like we have, privates, as you know, are private rates around first it would be 10 to 12, and then your seconds plus a lender fee. Then you have like your seconds 12 to 15 plus your lender fee. I mean, pretty good rates. Just got to evaluate the risk and see if it's a good fit for what you're trying to do.
Yeah. There's a lot of hype in the media. You can't turn on the TV or, Facebook is the worst. You go from, when the market started to shift, probably was February of this year. Before that, it was nothing but good news, nothing but positive. And now it's like nothing but crash, nothing but bad news. So you really got to, take what you read, with a grain of salt these days. I mean, how do you find that? I mean, like I hear some reports that, oh, stuff has dropped in value like 30% in Toronto. It's like, can that really be true? Like, what are you comparing that to? You know what I mean?
Well, in my case, honestly, I try to just, I don't like to pay attention to news, quite honestly. Like, I want to stay informed, but at the same time, there's like a certain aspect of negativity that you kind of have to just block. So sometimes being somewhat, I want to say the word ignorant is the right word, but just at least putting kind of a buffer in terms of the news that you get is not a bad idea. But to your point, I mean, the media is going to want to sell headlines. They're going to be comparing to July. They're always going to say, oh, the peak was 1.3 million in Toronto, and it's gone down 30% or 20%, depending on the area. But they're always trying to make those comparisons, right, from the most extremes. But if you look at it from the last year, the last 2 years, last 5 years, I mean, this is a long game at the end of the day. So get away from short-term thinking and more kind of a long-term thinking. And that's kind of beauty what I like about real estate, especially the long-term buy and hold strategies, is that you got to look at it from a long-term perspective.
Yeah, and there's no doubt there's a shortage of. I think like there is definitely a housing shortage, but I think there's also a shortage of landlords because without landlords, there's not going to be rental accommodations, and the government can sometimes help and they can sometimes be an obstacle. And I know in a lot of cases, I know Ontario, like British Columbia, is a rent controlled province. So the strategy to stabilize a building, if the markets are very much below market, is a lot different than it would be on the prairies. I mean, we can go and we can raise rents twice a year in Saskatchewan unlimited, for example. And I've kind of been hearing things too. Now they're talking about something called vacancy control or decontrol. So that not only can you not raise the rent on the tenant that's there, you can't raise the rent on the tenant that comes in. Is there any truth to that, or is this something that could be coming soon?
That's news to me, Corey, honestly.
Okay.
I have not heard that. I mean, rules in Ontario, there's rent control. Yes, every year you can only increase it so much. There is a special form that you can increase it by an additional 3% if you kind of spend a little money on your building and you have to justify it. Still not going to be able to cover. And then, yeah, so basically the rules are you can set it back to market if you have a tenant that turns over, or if you have something built that wasn't occupied previous to December 2018, then you can basically, it goes at market. So something like a newer construction would basically fall under that. So you can basically increase your rent once a year on that. On the subject of rent control, at the same time, like it's also hindered people from moving. So at the same time, like your vacancies are really low because, well, someone that's been staying there for 20, 30 years is incentivized to stay there. And as a result, like, how do you get how do you get people to move, right? Like, and so as a result, it's also put upward pricing pressure on people who are looking to rent a new place, for example, right? So.
Yeah, and like imagine like rents are kind of all over the map. I know in Alberta, if I'm going to buy a building, I'll do a rental survey on an area. I'll survey a bunch of the buildings. But I was asking someone in Ontario about that, and like, well, what's a rental survey? Why would we do that? Because you can have a multifamily building where you have tenants paying 1,500 and 600 in the same building. That's not uncommon because of the laws.
That's crazy. I mean, what can I say? It is what it is.
Yeah.
With rent control. I mean, that's also part of the reason why I hear a lot of investors going to states and going to landlord-friendly states and investing there.
So I want to just talk about the transaction. So like you're basically your buyer. I know a lot of the sellers that I deal with, with the walk-up apartment buildings, let's say they're, 10, 12, this 15 suite or 24 suite or the smaller buildings. A lot of them are the classic mom and pop operations. They've owned these things for, 20, 30 years. They paid the mortgage down. The new buyers that are coming in now, I imagine there's not a lot of like, mom and pop operations. Are you seeing a lot of like, maybe smaller investors that are, maybe have a townhouse portfolio that they're scaling up? Or are you seeing it's mostly like larger institutional players like REITs and pension funds? And is it more the 50 plus a door range, or is there still a sweet spot in that kind of, 10 to 24 range that the sort of average everyday Joe can get in on?
Yeah, so sorry, just turn up my phone here. My apologies.
Okay.
So, I mean, what I find is like people who are looking to get a multifamily, like the competitive space is like the 1.5 to 2.5 million. That's usually the person that has an existing portfolio that's looking to, like the mom and pop sort of investors that are looking to get into that space.
Yeah.
So, and that's going to be like a sixplex or sixplex more or less, maybe upwards of 8 to 10 doors, something like that. And then you get from like 2.5 to 5, and like that won't get into the institutional sort of crowd. Like you have to go much higher to get into that space. But then 2.5 to 5, probably going to be like a sort of a small syndicate or just a guy with deep pockets, whatever the case may be. But the REITs, I mean, that's a much larger, obviously, it's a much more expensive space to play, sandbox to play in, basically. That's just what I've seen personally.
So like it seems in some areas, like you mentioned Kitchener and maybe London, like it is possible. There are transactions. People are buying like 20 suiters for the low 200s a door. There are transactions that are going on like that. And now there's not 10 offers on these buildings. So there's probably, people are taking the time to do the proper due diligence. They're probably doing at least 60 days financing, 30 days due diligence, full walkthroughs, and maybe even time for CMHC application. Oftentimes you couldn't even get a vendor to do that because of the intense competition. I don't know what lead times on CMHC are now, probably a good 3 months for the mortgage. But are you seeing any transactions like that? People going to CMHC right away?
Not really. No, I think
Okay.
I haven't really seen that per se, just because again, this is the timelines and the pressures on that. I think a lot of the investors that I've seen, at least they want to kind of, if anything, kind of do short-term financing and then refinance once they kind of stabilize the building and have time to actually then with the CMHC, because then you're paying all those fees too, right? At the same time, so you want to basically, and with rents so depressed, like if especially if you're turning around a building and rents are so low, it doesn't really make a heck of a lot of sense. Otherwise, at least from my viewpoint.
Yeah, no, you're right. Yeah, because you can only get so much equity. So that's the challenge, right? You can either get a 50% loan to value at asking, or you have to have a bridge where you have to stabilize it. And that's oftentimes where a vendor take back comes in, where you can go to the seller and offer a second mortgage. Do you see that in Ontario? Is that pretty common, or is it more often that people go for bridge financing?
No, it's a combination of both for sure. Yeah, you see it. Depending on, of course, the seller and their willingness to work with you on that. But I knew a colleague of mine. He got a VTB for 10 years at 4%.
Wow.
Yeah,
you never know until you ask, right?
Exactly right. Majority of sellers want to cash out, but you just have to ask the question, like you said, and find out what the options are available, and maybe. Oftentimes you'll get it if you offer a sweetener, right? Their price, whatever the case may be, to kind of sweeten the deal.
Yeah, and oftentimes like a problem with people with money is what to do with it. So they could sell this building and maybe they can defer their gains over a couple of years and maybe make some interest off it at the same time. But you're right. I've seen most people want to clear up an estate. They have a reason for cashing out. Maybe they're reluctant to do a VTB, but there's definitely win-win for both parties if you can come to that consensus, for sure.
Absolutely. Yeah. I mean, it's great. Get creative with the financing. Luckily, a lot of times when you're dealing with people like that, they understand it, right? You're not, they get kind of what you're going after, and hopefully it's a win-win for both sides.
Well, Thomas, I know you're a super busy guy. I know you got to run, you got meetings, but I really want to thank you for taking some time out and, sharing your insights on the market in Ontario today, especially with multifamily. So how would people get a hold of you if they want more information?
Yeah, so again, it's Thomas Bowiewski here. I'm at Royal LePage in Mississauga, Ontario. So office number here is 905-568-2121. I've definitely got Facebook. We've got our Facebook page. We've got on social media. And I can certainly share those details with you, Corey, as well, if you want to kind of drop that into the post.
Absolutely, I will do for sure. All right, so I'm just gonna end the live stream here, and again, thank you for appearing on the show.
You're very welcome.